Good evening, everybody. Welcome to this third day of the ACCA Prepare to Pass webinar for Taxation Pakistan variant. My name is Lukman Rafiq, and I'm the tutor for this paper. We have had very fruitful 2 days where we have actually gone through the basics of sales tax and we have discussed about the basic concepts of sales tax which are applicable in Pakistan. Up till now, what have we done? We have discussed that what exactly is the sales tax in Pakistan, how do we compute input tax, how do we compute output tax, what are inclusive values, what are exclusive values. We have talked about the taxable, the exempt, the zero rated, reduced rate, third schedule supplies, all of them. We have talked about how the output tax liability is computed, and then in yesterday's session, we attempted several questions, and while attempting those questions, we actually did go through several rules. And if I could just have a quick recall of the various rules that we have actually gone through in the yesterday's session, that included number one point is basically if any purchases are made for which payment is not made through company's bank account, then input on such purchases shall be disallowed. So that was one of the important learning lessons from the taxation point of view. The second thing is that if the purchases are paid in cash, there are few purchases which are allowed to be paid in cash. Like for example, if you pay for the electricity, you pay for electricity, or you pay for maybe transportation, etc. So that is allowed to be paid in cash. Then we did talk about that income tax pertaining to exempt supply is not claimable because whenever you supply exempt goods, so what happens is the input tax on them is not adjustable, not claimable. Then we talked a bit further about input tax pertaining to zero rated supplies, adjustable, refundable. Further tax of 3% is charged. Then we talked about the time of supply. We discussed that goods mentioned in fifth schedule are subject to sales tax at 0%, and so on and so forth. So this was basically mainly the repetition of whatever that we have discussed through the exam questions or through the various definitions that we have discussed over the past 2 days. Our session for today is also going to be based upon the sales tax, and half of the session is going to be based upon sales tax, and the remaining half I shall actually be going through some of the aspects of the income tax. So the first thing that we are going to do today is basically, now let's try to understand this thing. First of all, up till now, what have we discussed? We have discussed that there is actually a concept of registered and unregistered person in sales tax. There's actually a concept of registered person and unregistered person in sales tax. So now a very important point is that who is a registered person, who is an unregistered person. So we need to understand that, because what happens is a very important aspect of the sales tax law is who is required to be registered, who has to get registration for the sales tax, and who is not required to be registered. Like there are many businesses operating, so is every business required to be registered? So that is something that needs to be established. So what we are going to do is that now we are going to discuss few sections of the sales tax where we will discuss that who is required to register, how the registration process takes place, and then at the same time what is actually going to be a deregistration process, and so on and so forth. Now if I talk about it, the first thing that we need to understand is it says every person engaged in making taxable supplies in Pakistan. So basically what happens is, number one, anyone who makes local taxable supply, he or she is required to be registered, including zero rated supply. So the zero rated supply is also considered to be a taxable supply because the tax is charged upon it at 0%. In the course or furtherance of any taxable activity carried on by him, falling in any of the following categories, if not already registered, is required to be registered under this act. Now, who? A manufacturer who is not running a cottage industry. Now, a very important point. First of all, if you are a manufacturer and you are selling exempt goods, you are not required to be registered. if you're a manufacturer selling exempt goods, you are not required to be registered. Now, what do we mean by this? I'll give you name of two of the companies. The name of the company is Al Ghazi Tractor, Al Ghazi Tractor, and there is another company which is called Millat Tractor. So you've got two companies. One of them is termed as Al Ghazi Tractor. The other one of them is termed as Millat Tractor. Both of these companies, what they do is that they manufacture tractors. The tractors are exempt. The tractors are exempt. So if the tractors are exempt, although these companies are manufacturers, they're not required to be registered for the purpose, for the only reason because they are selling tractors. Because the reason behind that is the tractors are exempt supplies. Now let's move a bit forward. So it says a manufacturer who is not running a cottage industry, a very important point. Like for example, what is a cottage industry? So the law gives a definition of cottage industry. The definition of cottage industry is where your annual turnover is basically less than 10 million and utility is less than 800,000 a year. So where turnover in the 10 months is less than 10 million and your utility is less than 800. Utility would include everything, which is the electricity and electricity along with that telephone, gas, etc. everything. So in case if you are such a company, then you will fall under the definition of cottage industry. If you are such a company, you'll fall under the definition of cottage industry. So you will fall under the cottage industry. So if there is anyone who is a manufacturer, now if you are going to ask me the definition of manufacturer, so you could remember from our session yesterday that we did discuss about who is a manufacturer, because there is a complete definition of manufacturer. So basically, if you are a manufacturer and if your annual turnover is more than 10 million, you are required to be registered. If you are a manufacturer, your annual turnover is less than 10 million, but your utility bill in combination is more than 800,000, you are required to be registered. So every manufacturer who is not running a cottage industry is required to be registered, number one. The second thing is who else is required to be registered? Let's talk. A retailer. A retailer who is liable to pay sales tax under the act or rules made thereunder, excluding such retailer required to pay sales tax through his electricity bill under subsection 9 of subsection 3. Now what happens is there are few retailers, like every retailer is required to be registered. Every retailer is required to be registered, but there are specifically few retailers who are prescribed under the various sections, and they are actually not required to be registered for sales tax if their sales tax is charged to them through their electricity bill. Now every importer, so who is required to be registered? A manufacturer. Number two, retailer. Number three, an importer. Number four, an exporter. Very important, but only if he intends to obtain. If he intends to obtain sales tax refund against his zero rated supply. So it's only if the exporter intends to claim refund against his zero rated supply. Like for example, you are registered as an exporter, but you make local supplies also. So if you are making local supply, you cannot claim import against them. Number two, you are an exporter who is exporting goods, but you don't intend to claim refund. You don't intend to claim refund. You don't want to claim refund. So it's not necessary for you to get registered. You can just operate without registration also. Further, it says a wholesaler, dealer, or distributor. So every wholesaler, every dealer, every distributor, it's mandatory for them to get registered. Now, why is it important? Because every person who is required to get registered, if he doesn't get registered, then what happens is the tax authority, once they figure out, they can charge a severe penalty upon that person because he did not get registered. Now, who else is required to be registered? A person who is required under any other federal law or provincial law to be registered for purpose of any duty, so and so, so and so. So this is what a registration requirement is. Like everyone who is either manufacturer not running a cottage industry, every retailer, every importer, an exporter if he intends to claim a refund of his exports against his zero rated supplies, also a wholesaler, dealer or distributor, and anyone else who is required under the provincial or the local laws to get registered is required to be registered under the sales tax rules under the Sales Tax Act 1990. So that is basically an important concept of registration. Anyone has any questions with respect to registration, please do ask me. Then I am going to move forward. If you have any question relating to registration, please do type. Thank you. Yeah, any questions, please? Any confusions that you may want me to clear, please do let me know so that I could clear and then I can move forward. Okay, so there are no questions. Let's move forward and let's discuss further. Okay, so let's move and let's discuss about the next aspect. So the next aspect of the question is basically that we now need to understand the concept of deregistration, blacklisting, and suspension of registration. Now, what exactly do you mean by deregistration, blacklisting, suspension? Let's try to understand. When we talk about the concept of sales tax, a very important aspect of sales tax is that the first and the foremost thing is to get registered. Once you have gotten registered, then at times what happens is you may actually require to get deregistered. And there's the concept of blacklisting and there's the concept of suspension. Let's try to understand. You are registered with the tax authorities for the purposes of you registered with the tax authorities for the purposes of sales tax. Now there might actually be an area, there might actually be a time period when you are non-compliant with the rules and regulations of the Sales Tax Act. So usually what happens is if you are non-compliant, so generally speaking, the registration is suspended. And the penalty for the registration suspension is usually that the input that your customers cannot. So the important thing is that in case if you are not registered for like for example if you're not compliant, then what happens is during the period of your suspension, because it's actually a temporary nature, the suspension is usually temporary nature. So in case what happens is, if you are not registered, sorry, if you are suspended, then what happens is during the period when you actually issue invoices during the period of suspension, people cannot actually claim the input on your invoices during such time period. Now, what next is there? Let's talk. The blacklisting is basically generally the inputs are disallowed for a specified period, and it operates backdated. It operates backdated. Like for example, if you are being blacklisted, then what is actually going to happen? If you are being blacklisted, then what is actually going to happen is that the government will prescribe a time period, say 4 months, say 5 months, say 7 months, and the government is going to say that whatever the sales that you have made during those last 6 months, 7 months, uh, those sales and the inputs claimed on those sales will be disallowed. So that's what generally happens with the blacklisting concept. Now let's move forward. So if I talk about this, that what exactly is this, who is eligible to get deregistered, and how do you get blacklisted, and so on and so forth. So I'm going to discuss all this now. First of all, there is basically this concept. It says the board or any officer authorized in this behalf may subject to rules deregister, may subject to rules deregistered a registered person or such class of registered person not required to be registered under this act. Generally speaking, what happens is when we talk about the concept of deregistration, the deregistration, what it actually happens is the deregistration majority of the time, this deregistration happens because you are now supplying exempt goods. Maybe your supplies become exempt. Maybe you close the business. Maybe you sell the business. Maybe you merge a business with anyone else. So then usually what happens is you go for deregistration. So what is generally deregistration? When your supplies become exempt. You go for deregistration when you close down the business, you sell the business, or you maybe merge a business with somebody else. Then you actually go for deregistration. So these are the things, or at times what happens is you may actually get deregistered because of non-compliance also. Like maybe you may not be compliant with the tax rules. So the authorities are gonna gonna give you ultimatum that you have got X number of periods, X number of time in order to ensure that you complete your compliance. If you complete your compliance, then good enough. If you don't complete the compliance, then actually what happens is you are actually you actually get deregistered without any request. In fact, the authorities did themselves deregister you. Now, a lot of you people would actually say that is it advantageous to get deregistered or is it disadvantageous to get deregistered? So I'm going to tell you that it's very disadvantageous to get deregistered, because when you are dealing with the customers, your customers are buying from you, and one of the major reasons for your customers buying from you is because you are registered. Had it been the case that you are not registered, your customers might not have actually bought the goods from you. So that is something that actually happens. Now, what next is there? Let's talk. If I talk a bit further, let's discuss. The next thing is, it says, notwithstanding anything contained in this act, in cases where the commissioner is satisfied that a registered person, is found to issue fake invoices or has otherwise committed tax fraud, he may blacklist such person or suspend his registration in accordance with such procedures as the board may in the official gazette prescribe. Now what happens is a very important point. What is the concept of this blacklisting? The blacklisting is, as I mentioned, generally what happens is if you are being blacklisted, then you are not allowed to claim input for a certain period of time. If you are blacklisted, you are not allowed to claim input for a certain period of time. The reason behind that is actually a sort of penalty. And also the invoices that you have issued to third parties, those third parties cannot also claim the input. Also, the government usually prescribes a period that the inputs that had been claimed for certain period of time, they will also be disallowed. So generally these things, they actually happen with the companies when they go for this tax frauds or issuance of fake invoices. So the government goes for the blacklisting of such companies. So if any company is blacklisted, people will obviously not be trading. In fact, even those people who traded with them in the past are going to be regretting, because this company is blacklisting and the entire input that has been claimed during certain time periods, the past periods, would be disallowed. Next, it says during the period of suspension of registration, the invoices issued by such person shall not be entertained for the purpose of sales tax refund or input tax refund. And once a person is blacklisted, the refund or input claimed against invoices issued by him, whether prior or after blacklisting, shall be rejected through a self-speaking appealable order and affording an opportunity of being heard. So basically, if you get blacklisted, it's a very dangerous thing for your customers, for you both. Now let's move a bit forward. Let's talk further. So this is generally what happens with respect to this blacklisting and the suspension and the deregistration. Now, the last thing is, it says notwithstanding anything contained in this act, where the board, the concerned commissioner, any officer authorized by the board in this behalf has reasons to believe that a registered person is engaged in issuing fake or flying invoices. What is this fake or flying invoices? That's dummy or fictitious invoices. Like, I have sold you computers, but I have issued invoices for steel bars. I've sold you steel bars, but I have issued invoices for sugar. So this is what is considered to be fake and flying invoices. I have not made any sales, but still I issue an invoice to you. That's all fake invoice. So if the commissioner has a reason that you are involved in issuing fake or flying invoices, uh, so basically what happens is that the commissioner may block the refunds or input tax adjustment of such person and direct the appeal commissioner for further investigation and appropriate legal action. So basically what happens is, it's not necessary that you get blacklisted. It's not necessary that you get suspended for your inputs to be disallowed, for your refunds to be blocked. Even when you are registered, but and if they have a reason to believe that you're involved in issuing fake and flying invoices, they may actually deregister you, they may actually block your refunds, they may actually disallow your input adjustments. Okay, lastly, with respect to this registration section, there's another concept which is called the concept of active taxpayers list. The active taxpayers list, this concept has been introduced for last 2.5 or 3 years now. And what happens is, generally, the government, it issues an active taxpayer list. If you could go to the FBR website, like for example, this fbr.gov.pk, the Federal Board of Revenue. When you're going to go to their website, this is this FBR, income tax, sales tax, ATL, sales tax. This ATL, income tax. This is ATL, sales tax. So this is basically this active taxpayers list of income tax. This is active taxpayer list of sales tax. Now, what I am going to do is that if you are trading with anyone, what you could probably do is that you could check their status, whether they are active or whether they are not active. Because generally, if somebody is not active, then there is a likelihood that that person may get suspended or blacklisted in the near future because of their non-active status. Now, I'm going to this is actually a list of active taxpayers that the government has published. So this is usually updated every week. This is updated every 1 week. So it will have a huge list. And what we are going to do is that we're going to just check this list so that you people can have an idea that what exactly is this list all about. So I'm going to show you, but for the time being, you can click on this to check your active taxpayer status. Okay, what I'm going to do is that I'm going to show you my active taxpayer status so that you just can have an idea. Okay, if you could just see that this is basically my status, this is my registration number, this is my name, this is my business name, and my filing status is that I'm an active taxpayer. Now, it's an active taxpayer list of income tax. It's not an active taxpayer list of sales tax. If you're gonna look at the sales tax thing here, you'll not find my name because I'm not registered for sales tax. It says, sorry, the image character does not match. The main reason is that I'm not registered for sales tax because I'm not required to be registered. Furthermore, if any one of you wants to know the NTN of yourself or anyone, what you could do is that you could just go to this again. Okay, there is an error from my side. I did not input the right information. Um, okay, here you go. So it's basically like you search out any taxpayer, you get the NTN number. So it's my NTN, it shows my name, it shows my status, that I'm an individual, and so on and so forth. Here is actually a list of all the people. Here's actually a list of all the people which you could probably figure out. Here's a list of all the people. So it's basically part 1, part 2, part 3, part 4, part 5, part 6, part 7. And what actually happens is, if you could just look at it, it shows to you the name of the person, it shows to you their business name or the business address, and their name and the CNIC number, and so on and so forth. Okay, so basically, this is the concept of active taxpayers list that FBR has actually issued this specific notification, where they actually intend to say that uh, anyone who is compliant, who is filing the tax returns on a timely basis, he would be considered as an active taxpayer. So every active taxpayer, he can claim refunds, his input will be allowed, and so on and so forth. There are various advantages of being an active taxpayer. If you just want to see, you could just see it here also. It would actually tell you the benefits of the active taxpayer. It's going to show you the active taxpayer benefits. Now, what is it? Lower tax rates of tax deduction at source, reduction on withholding tax, lower rate of tax on buying and selling of property, and so on and so forth, allows you to claim overpaid tax. So this is how it actually goes about. Active taxpayer list, this is how things go about. So I hope that everybody is okay here. Okay, so that marks the concept of registration, deregistration, and blacklisting and suspension of a person for the sales tax purposes. We are now going to move forward, and we are now going to move on to the next area. The next area is we're going to discuss about the bookkeeping and the records. Now, what exactly do you mean by bookkeeping and the records? Let's try to understand that what is this bookkeeping and the records. So basically what happens is when you are registered for the sales tax, you have to ensure that you retain certain records and documents, because when you retain certain documents and records, so the tax authorities, when they select your case for the audit, they are actually going to require you to submit those documents. If you are unable to submit the documents, the tax authorities may actually doubt whatever things that you have claimed, like the inputs that you have claimed, or the sales that you have shown, or the bank payments that you have made. So there is a list of documents that needs to be kept by every individual, by every association of person, every company, for the purposes of their sales tax. So we are now going to discuss them and see that what exactly are they. You'll have access to these handouts in the handout section of this webinar window. So when you will access the handout section of your webinar window, you'll find this. Please do access the handout section so that you can download this. Okay, have you been able, are you people able to find it? Okay, let's talk. Now, when we talk about the concept of records, so what exactly do you mean by records? So every single person who is registered for sales tax is required to maintain a certain records, and those records are required to be produced to the authorities as and when they demand. Now, what exactly are those records that need to be kept? Let's talk and let's discuss. The records that need to be kept are, number one point is okay, first of all, it says that where do you need to maintain the records? A registered person. Who is required to maintain? A registered person making taxable supplies. shall maintain and keep at his business premises or registered office in English or Urdu language. A very important aspect is you might try to maintain the records in a Gujarati language or Sindhi language or in any other language. That record is not going to be acceptable. All that you have to do is that you have to maintain the record, and that record should always be in the English or the Urdu language. And you need to maintain those records. You need to keep those records at your business premises. Furthermore, it says um, um, the following records of goods purchased or imported and supplied made by him or his agent acting on his behalf, and so on, so, so, and so. Now, records of supplies made. So you need to maintain the record of supplies, and the supplies record would obviously indicate the quantity, the value, and the name and address of supplier. So name and address of supplier. Now, what is the second record that you need to maintain? Let's try to understand. The second record that you need to maintain is records of goods purchased. It's a record of goods purchased. So that is also required to be maintained. The third thing is record of goods imported. Fourth is record of zero rated and exempt supplies. Fifth is double entry sales tax account. Number 6 is invoices, credit notes, debit notes, bank statements, inventory records, etc., etc., etc. 7 is about the gate passes. 8 is about the other records specified by the board. Now let's try to understand. Basically, what happens is when you go to the sales tax authority, what do you submit to the sales tax authority? You submit your sales tax return. When we submit our sales tax return to the authorities, our sales tax return actually indicates all the inputs that we have, indicates all the outputs that we have. So if it indicates all the inputs that we have, so what is it going to show? It is going to show all the purchases that you have done. It is going to show all the imports that you have made. It's going to show all the exports that you have done, all the exempt supplies that you have made, all the local supplies that you have made. Further, other than this, if we talk about this sales tax, so what is the next thing that is actually going to happen with respect to sales tax? Let's try to understand. The other thing that is going to happen with respect to sales tax is you need to maintain the record of your bank statement, because it is important that you make payment through the bank. So like every single thing that could verify your purchases, every single thing that could verify your imports, every single item that could verify your exports, could verify your exempt sales and your local sales and your payments and receipts, you need to maintain a record of them. So that's why it says records of supplies, records of goods purchased, it says record of goods imported, then it says records of zero rated and exempt supplies, further the double entry sales tax accounts, the invoices, credit notes, debit notes, bank statements, so on and so forth. Otherwise, it's records relating to gate passes and so on, so on, so on, so. So these are the records that you actually have to maintain. Now, how do you need to maintain these records? You need to maintain these records either in English or in Urdu at your registered office. Further, it says the registered person whose accounts are subject to audit under the Companies Ordinance 1984 shall be required to submit a copy of annual audited accounts along with a certificate by auditors certifying the payment of due tax by a registered person. Now, it's an important thing that if you are somebody who is a company, if you are a company, so as a company, what you need to do is that you need to maintain a copy of your annual audited accounts, and your auditor has to issue a certificate. Now, what is the certificate that your auditor has to issue? The certificate that your auditor has to issue is that he has to um, confirm that um, that you have made the payment of whatever the tax that is due to you. So these are the records that need to be maintained by every person. Now, what is the second record? It's about the tax invoices. Now, a very important point. When we claim input, what do we have with us? It's the sales tax invoice that we have. So if it's the sales tax invoice that we have, so a very important point is that invoice should mention certain things which are necessary. Now it says what? A registered person making a taxable supply shall issue a serially numbered tax invoice in either Urdu or in English language. And that invoice should have name and address of supplier, name, address, and registration number of recipient. Number 2 point is the date of issue of invoice. Third is the description. Fourth is value excluding sales tax. Fifth is the amount of sales tax, and then the value inclusive of tax. So if I could just give you an idea about how the invoice should actually be. So basically what happens is the invoice has your name, your registration number, the date of the invoice, and the invoice number. Then it's the customer name, registration number. That's important. Then you've got what do you have then? You've got the description, you've got quantity, you've got value, you've got sales tax, you've got inclusive value. So this is all that is required to be mentioned on the sales tax invoice. So if you have a sales tax invoice, a sales tax invoice should have these characteristics. The sales tax invoice should have these characteristics. Now if the sales tax invoice have these characteristics, so what is actually going to happen is um, so this is what a sales tax invoice has to comply with. Is it okay to everyone? Okay, so this is what the sales tax invoice should have. Now let's move forward. The next thing is retention of records and documents. Now what happens is if you are operating with the authorities have the right to inspect your records. When you are operating, the authorities have the right to inspect your records. And when they have a right to inspect your records, so for how long do we need to retain the records? The tax law says that you need to maintain the records for a period of 6 years from the end of the tax year. From the end of the tax year, you need to maintain the record for a 6-year period. Now, what is the record that we need to maintain? The record we need to maintain is basically whatever the above mentioned, like the bank statement, gate passes, invoices, delivery challans, payments, payment vouchers, so on and so forth. All of these things have to be maintained. Now there is something else also mentioned in this specific section, that is at times what happens is you are being investigated, like sales tax audit might be investigated against you, or there may actually be the case where you are being investigated under the ATR, the alternative dispute resolution, or anything. So basically what happens is, even if 6 years have passed, but if your case is pending against any court or any department or anything, then what can happen is you need to maintain the record till the end of till the end of such proceedings. Next is another section which is about access to records and documents. Now let's understand. Basically, what happens is uh, a commissioner is a commissioner has the power to inspect your premises and inspect the records and the documents that are held by you. A commissioner has a power that what they can do is that they can come and they can access and they can ask you for various records that are made placed, because the reason behind that is uh, you are required to maintain the records at your registered office or your business premises. So in case, if just in case if you don't have the records, the commissioner or the person to whom he has designated the power may actually take any action against you. Okay, there is another concept which is called drawing of sample. Let's try to understand. What is the concept of this drawing of samples? At times what happens is, assume that I'm manufacturing a product and I'm claiming that I'm using 4 kg of a material. Whereas what is actually happening is I'm only using 1 kg and I'm selling 3 kg of material to the external market, and I'm not declaring that sales. So I'm just saying that I'm actually using 4 kg of materials. Now, if I am using 4 kg of materials, so what is actually going to happen? If 4 kg of material is being used, then basically the authorities, what they do is that they have doubt about the formula of the product that I'm manufacturing. So what the authorities can do is that they can come to your premises, they they can draw certain samples of the goods and send them to the laboratory. So usually what happens is, if the authorities, they visit your premises and they draw samples from your inventory and so on. So what they actually do is that they give one of the sealed sample to you also. So just in case if you disagree with the lab report, the sealed sample which is given to you can actually be the sealed sample that is actually given to you can actually be withdrawn from the records and could be given to um, could be given to the lab. Yeah, is it okay to everyone? Anyone has any question? Okay, so we are done with this specific section, which was about the bookkeeping and the records. And if any one of you has any questions, please do ask. Okay, now a lot of you who have actually joined in a bit late, what I have been doing in the past is I have been telling students a bit about this webinar. So I'm going to guide it again. I've been guiding it for the past 2 days also. First of all, let me explain to you that this specific webinar is being conducted for the Taxation Pakistan variant. This specific webinar is being conducted for the paper Taxation Pakistan variant. This is not for UK variant. This is not for any other country's variant. It's for Pakistan variant. The Pakistan variant paper is not held 4 times in a year. It's instead held twice in a year, which is every June and every December. So basically what happened is ACCA Pakistan initiated this thing of conducting the practice to pass session for the taxation Pakistan variant, so that resource can be made available for the students who want to attempt the paper but were reluctant to attempt it because of the lack of resources. So what happened is I conducted a webinar for ACCA in September attempt, and that was for this specific paper Taxation Pakistan variant only. And basically what happens is when we talk about the syllabus of this paper, so the syllabus of the paper actually has got multiple sections. So amongst the multiple sections, what we actually did was we did some of part A, we did in fact almost the entire part B, we did some of part C, um, and we did part D completely, and we did not attempt part E. So in the previous webinar, I have actually gone through various parts of the syllabus, and the webinar is available on the ACCA website. If you go to the ACCA website, you'll find this specific page, which is Practice to Pass ACCA Exam Approach Webinars 2019 December. You go to this specific page, and on this specific page you'll find this Practice to Pass revision resource and recorded webinars. When you are going to click this Practice to Pass revision resource and webinars, here you will have this handouts and the links file. What you could do is that you could download this file, and once you're going to go onto this file, on the sixth page of this file, on the sixth page of this file, you'll have this 5 video links to 5 videos for the September 2019 exam session that I conducted. Well, uh, there was supposedly no paper that was to take place in September 19 for the F6 Pakistan variant, but because ACCA wanted the syllabus coverage, so that's why they had this webinar conducted. So this is what the 5 lectures are. You can go through these 5 lectures to get an access to a significant portion. And then I'm now conducting the webinar. So now I'm actually conducting this specific sales tax section. And also I'll be conducting this part A remaining section and some of the part C that is pending. So this is what this is how things are actually going about. Also, for those of you who are unaware, what I'm actually doing is I'm going through the syllabus of this paper, uh, and the sales tax section. I'm just going to open the sales tax section of the paper. Okay. There are a few reading lists that is mentioned: Muhammad Arshad, Income Tax Case Law and Explanation, Sheikh Asif Salam, Dr. Ikramul Haq, and Muhammad Arshad. Now, this is not to disregard anyone, but my suggestion to you all is going to be, rather than reading these books, it is going to be more advisable for you to actually go through one of the books, which is basically of Mr. Khalid Petiwala. So one of the book that you actually need to do is of Mr. Khalid Petiwala. that book is going to be of a lot of help for every one of you. So it's basically the taxation for GAF 6 by Khalid Petiwala. And also there's one more book which you can go for. It's the ICAP GAF 6 book and question bank that you can go for and have a good access to it. So these are the two books and the resource that I would recommend you people to use, because they are very exam focused and they are something that is going to help you as a student get hold of things rather than going into this. And there's one more for those of you who are in Lahore or anywhere outside Karachi. At times you get a bit difficulty in finding Khalid Petiwala's book. So in case if you're finding difficulty in having Khalid Petiwala's book, my suggestion is going to be there is another writer who is very, very good, and that is Mirza Munawwar Hussain. He has prepared his synopsis and they're also excellent synopsis. You can probably get a hold of those synopses also by Mirza Munawwar Hussain. They're also going to be of a lot of help for you people. So anyways, what have we done up till now? We were actually going through the sales tax. So I have gone through the concept of a scope of sales tax and the various other aspects, uh, the registration and the deregistration requirement, computation of sales tax, so on and so on. So lastly, um, there were a few more things which is basically discuss how the information must be given on a sales tax invoice. We have talked about it. It says about procedures for claiming sales tax return, sales tax returns, etc., etc. So I'm going to go through one last aspect, and then we will have concluded the sales tax section. So last aspect is about the sales tax return. Okay. Okay, before we proceed with this, let's talk. What exactly is a return? So when we talk about a return is actually declaration. A return is actually a declaration by a taxpayer to the authorities. For the sales tax, there is usually a monthly sales tax return that needs to be filed. And that monthly sales tax return is to be filed by the 15th of following month. By the 15th of following month. I'll open up a sales tax act in front of you. In fact, I'm going to show you that what exactly is a sales tax return, how does it look like. So I'm going to show you the sales tax return. Okay, so you could see the sales tax rules. Whatever that is mentioned in the sales tax act, that is not descriptive, that is not very explanatory. So in order to explain them, these sales tax rules are prepared. In order to explain them, the sales tax rules are prepared. Now let's have a look at this, that what exactly are these sales tax rules and what exactly are the things. Okay, let's discuss about it, that what exactly is a sales tax return and how does it look like and so on. So basically what happens is, when we talk about the sales tax return, generally speaking, what happens with the sales tax return is that the sales tax return tells you about the sales tax credits and the sales tax debits, and then the sales tax payable or refundable. Now let's try to understand. When we talk about the sales tax returns and debits and credits, so try to understand that how things actually go about. First of all, um, when you submit to the tax authority, this is just a summary of what we submit. There are various annexures like annexure A, annexure I, annexure B, annexure C, annexure I, annexure D, etc., etc. What happens is, you actually, this is annexure number. Uh, this is annexure number A, which is about the domestic purchases invoices. So what happens is, you input these various invoices here, like the NTN number of the supplier, CNIC, name, province, type of supplier, so on and so forth. Whatever that he does, you input that. Then there is this annexure number C, annexure number B, goods import details are mentioned, then the purchases details are mentioned, and so on and so forth. So the various information is actually entered into. Once we enter this various information, what happens is, this entire information is um, the entire information is reflected on the first page of the sales tax return. The entire information is reflected on the first page of the sales tax return. So you input on the annexures, and those annexures input is actually reflected on this first page of the sales tax return. Like whatever purchases that you've mentioned into, it's going to be reflected here. Whatever imports that you've mentioned, it's going to be reflected here. So the inputs for the month are like this, and then whatever you've got accumulated credits and so on and so forth. So this is how actually things go about when we talk about the sales tax refunds. Now let's move a bit forward. So this is what you submit or you declare to the tax authorities. And every month you have to submit this. Every month you have to submit this. So what does it say? It says that every registered person shall furnish not later than due date a true and correct return in the prescribed form to a designated bank or any other office specified by the board, so and so, so and so. Now it says, provided further that the board may, by notification in official gazette, require any person or class of person to submit such a return as may be prescribed, so and so, so and so. If we talk a bit further, it says the registered person may, subject to approval of the commissioner having jurisdiction, file a revised return within 120 days of the filing of the return. So every registered person is required to submit a return. There are further things about like a special return. So what is a special return? In addition to returns specified, it says a person registered shall furnish a special return within such date and such form indicating information such as quantity manufactured or produced, purchases made, goods supplied, so and so, so and so. And there's this final return. What is this final return? This is submitted at the time of deregistration. It's submitted at the time of deregistration. So whenever you deregister, there is a final return that is submitted to the tax authorities, and that covers up the various things that you actually declare to the government at the time of conclusion of your tenure as a registered sales tax person. So that is considered to be a final return. So basically, if I sum up all of this, the conclusion is that when you talk about the sales tax return, every person is required to file a monthly sales tax return. And then in addition to this monthly sales tax return, in case if you get deregistered, you are required to file a final sales tax return also. So that is something that you have to do. So I hope that this actually clarifies things to everyone. Okay, so we're done with this specific aspect of the sales tax. And what I'm actually going to do is that I'm going to take a short break now. And um, when we come back from the break, we're going to start off with one of the aspects of the income tax, and that is called the wealth statement. So when I'm going to come back, I'll start off with the wealth statement. What is this wealth statement? This is something that is part of the income tax that we are going to talk. So I'll go through the wealth statement first. So we'll have a break, and we shall inshallah start off. Um, it's a break till 9:25 p.m. So after the break, we will start off with a topic which is basically the wealth statement. Okay, so welcome back, all of you. Before we went on to the break, we actually had a discussion about the various aspects of the sales tax. Now, the next thing that we are going to be discussing will be we are now going to discuss one of the areas of the income tax, which is basically the concept of wealth statement. Now, before we go on discussing about the wealth statement, I'm going to have a quick introduction. I'm going to have a quick introduction of what the wealth statement is all about, so that you can have a good idea that what exactly do you mean by the wealth statement. Now, when we talk about the wealth statement, so you need to try and understand that basically what happens is, as per the income tax law, as per the income tax law, um, um, every person filing a return of income shall also file a wealth statement along with wealth reconciliation statement. So basically every person who is filing a return of income is also required to file a wealth reconciliation statement and a wealth statement along with his return. Now, what exactly do you mean by this? So let's try to understand. Basically what happens is, when we talk about this specific concept, so I'm going to explain to you people that um, every person who is considered to be a person as per the definition of a law, so every individual, every AOP, every company is considered to be a person. Every individual, every AOP, the association of person, which is also termed as partnership or the joint venture, and every company, they're all considered to be person. Now, so what we are being told is that every person, um, uh, generally speaking, what happens is we file an annual income tax return. So when you file an annual income tax return, it is made mandatory upon you, if you are an individual or if you are a partner of an AOP, that you have to file a wealth statement along with wealth reconciliation statement. Now, what exactly is this wealth statement and what is this wealth reconciliation statement? So let's try to discuss. The wealth statement shows what? The wealth statement shows following. The assets owned by person or the person's spouse or the dependent children. Secondary, what does the wealth statement shows us further? In addition to this, the wealth statement shows us the liabilities owed by, liabilities of a person, his spouse, or the dependent children. Further, the assets transferred slash sold slash gifted during the year, and details of expenses of the person, his spouse, and the dependent children. So basically what happens is, what is a wealth statement? From the accounting perspective, if you want to understand the concept of wealth statement, so wealth statement is simply a balance sheet of an individual. A wealth statement is simply a balance sheet of an individual that we submit to the tax authorities. Now, so when we talk about the wealth statement is simply a balance sheet of an individual submitted to the tax authorities, remember two few things, which is number one of them is a wealth statement is always prepared on a cost basis. Like, it's not prepared on a fair value basis, it is prepared on a cost basis. And the second thing that happens with the wealth statement is it shows the movement of wealth, and it's not a cash flow statement. It shows the movement of wealth and it's not a cash flow statement. So what it does is it actually shows you the movement of wealth. It's not a cash flow statement. Now, how do we actually prepare a wealth statement? So for that, let's try to understand. What I'm going to do is that I'm going to open up a question. Um, this is basically a question obtained from one of the past paper of the ICAP qualification. And this is basically a question named Zahid. A question named Zahid. Now, what I would want you people to do is that to go through this question, the requirement of this question is, it says prepares Zahid's wealth statement and wealth reconciliation statement for tax year 2000X7. So what I would want is, this question is available in the handout section of this webinar window. You can download and you can go through the question, then I'm going to start reviewing. So it's actually reading time, which is 5 minutes till 9:45 p.m. Kindly read through this question, then we will start discussing. Kindly read through it. Okay, so let's just start discussing. We have this question. It says that Zahid, the sole proprietor of FG and Company, is a resident individual and is in the process of filing his wealth statement for the tax year 2007. The relevant information is as under. The assets and liabilities disclosed in the wealth statement for tax year 2006 were as follows. The assets are given as this. The liabilities are given as this. The net assets are this. It says details relating to FG and Co. were as follows. Income from business during the period is this. Drawings during the business is this. The balance of cash in hand and at bank as on 30th June amounted to this, and rupees 730,000 respectively. It says transactions carried out by Zahid during the year were as follows. Now, how would you actually prepare the wealth statement? So what I'm going to do is that I'm going to open up this Excel sheet. And in this Excel sheet, I'm going to tell you that in order to prepare the wealth statement, there is actually a methodology which you need to follow. First of all, you need to just mention the wealth statement. This is basically the item, the amount as per question. Then you have got the adjustment. You might have multiple adjustments. So we are mentioning the net amount is there. So basically, how do we go about preparing the wealth statement? The wealth statement is being prepared like this. You need to actually make few headings and so on and so forth. So basically what happens is, this is how things are going to operate. Now, so you have got item, you've got amount as per question, the adjustment amount is there and the net amount is there. Now let's try to discuss. First of all, it says the assets and liabilities disclosed in wealth statement are as follows. So first thing is you're going to mention your assets as they are in the question. This is land in Hyderabad, land in Hyderabad. Then you've got property in DHA Karachi. Then you've got shares of listed company. You've got shares of listed company. Further, it says business capital. It says motor vehicle. Then there is this cash at bank. Then there's this cash in hand. I'll just leave a space for one or two of the other assets that may actually come on into the question. I'm leaving a space for them. Then I'm going to mention the liabilities. So the liabilities are basically one of them is a bank loan. So this is what it is. And you would say the net assets. Okay, so if I talk about the question, it's 5 million here. Okay, it's 5 million here. Furthermore, what happens is it says 3 million as per the property in DHA. You've got 1.1 million for shares in listed company. Then there is this 4 million, which is the business capital. It says motor vehicle 1540000. Then 600,000 the cash at bank. Then 300,000, which is the cash in hand, and the bank loan, which is basically 1.5 million. So resultingly, what happens is when we talk about the total assets are going to be and the net assets are going to be this minus this. So 14040 so and so. This is what the net assets are. So the first thing when you are preparing or when you are attempting a question on wealth statement, the first thing that you need to do is that you need to just copy the question as it was. You just need to copy the question as it was. In addition to the wealth statement, we are also required to prepare a wealth reconciliation statement. So I'm going to give a heading which is wealth reconciliation statement. So wealth reconciliation statement, you would say the net assets as at um, 30th June 2006. So the net assets at 30th June 2006 is basically 114.04 million. That's what it is. Then what happens is you will say there are going to be few things added to it. There are few things that are going to add the wealth, and there are going to be few things which are going to be deducted from the wealth. So we'll add few things, we'll deduct few things. Now let's talk and let's discuss. The first thing that we need to understand is it says details relating to FG and company are as follows. What is FG and Co? It's a business capital of the person. It says income from business during the year was this 2.54 million, and the drawings during the year is 450,000. So what would happen is income from FG, and that income is going to be 2540,000. Okay, so that is what we have with respect to the income. Now what next is there? So whatever income that will arrive, what would happen is you would put an entry into it. It's income from FG Inco. So the income from FG would actually also increase your business capital with FG. So how much is the income? This is 2540,000. And there is actually a drawings from the business. So the drawings from the business are going to reduce the business capital. So there's going to be a drawing of 450,000. There's going to be a drawing of 450,000. Okay, so basically what happens is so first thing is income from FG is going to be mentioned here. Anyone has any question, you can ask, you can just type it out. So the first thing that I'm doing is the income that I've received from FG, I'm just mentioning that income as something that's increasing my wealth. So it's 2540,000. Now what else is there? The next situation is um, the drawings during the year are this. It says balance of cash in hand and at bank as at 30th June amounted to 157,500 and 730,000 respectively. So it says it amounted to 157,500 and 730,000. So 157,500 is the cash in hand. and there is actually going to be 730,000, which is the cash at bank. 730,000, which is the cash at bank. I'm not making any adjustments here because I'm just being given the values directly, so I'm just mentioning the direct values. It says transactions carried out by Zahid during the year were as follows. He paid an advance of rupee 1 million against purchase of a bungalow for rupees 10 million. So what happens is we are going to say the advance against bungalow. And how much is the advance that he has actually paid? It's 1 million, the advance that he has paid. Okay, so what is going to be the impact on the wealth? There is going to be no impact on the wealth, because what he actually had was he had cash in hand. That cash in hand is now being converted into that cash in hand is being converted into the advance. So there is technically no impact on the wealth. Then it says sold shares of a listed company for 350,000. The shares were purchased for 50,000. The capital gain tax collected amounted to 37,500. So what happens is the shares were sold for 350,000. Now what is going to happen? You're going to say the investment in shares will be reduced by 50,000. Investment in shares will reduce by 50,000. And when we talk about the wealth statement, what is going to happen is you'll have the gain on disposal of shares. Gain on disposal of shares. And the gain on disposal of shares that is going to arise will be 350,000 minus 50,000. So it's going to be 350,000 minus 50,000. So resultingly 300,000 is the gain on disposal of share. Then the tax on gain on disposal of shares. The tax on gain on disposal of shares is going to be deducted here. Now how much is it going to be deducted? It is actually going to be 37,500 that will be deducted. So the tax is going to be 37,500 that will be deducted here. Now what next is there? It says gifted. Okay, now let's see. The shares of a listed company were gifted of a company to his brother. The shares were purchased by Zahid in 2002 at a cost of 100,000, whereas market value of the shares at the time of gift was 150,000. Now what is going to happen is you have gifted the shares of 100,000. What else is going to happen is there's going to be deducted the shares gifted to brother. Shares gifted to brother. So it is actually going to decrease the wealth by 100,000. Now what else is there? It says paid rupee 200,000 towards the principal amount of the bank loan. So if you're going to make payment towards the bank loan 200,000, So this is going to reduce the bank loan, but at the same time, it would reduce the cash also. It says personal expenses amounted to 2,075,000. The personal expenses will reduce your wealth. The personal expenses will reduce your wealth. Okay, so the personal expenses of 2,075,000 will actually reduce your wealth again. It's going to be something that's going to be reduced. Okay, what else is there? The next thing is, it says net receipts against agricultural income amounted to 2.5 million. So what happens is it's actually net receipts of agricultural income. And it turns out to be how much? It turns out to be 2.5 million. So if it turns out to be 2.5 million, so what is actually going to happen is you would say that the wealth statement, how much was it? It was 14.04 million. There was an increase and the decrease. So what happens is equals to the sum of all this. So this is going to tell us net increase slash decrease in wealth. This is going to tell you net increase or decrease in wealth. So resultingly, the closing wealth statement would turn out to be this. This is going to show you net assets as at 30th June 2000 X7. This is going to show the net assets as at 30th June 2000 X7. 17167,500, and you could see from here also it turns out to be 17167,500. So what have I simply done? It's about the wealth plus the wealth reconciliation. So if you people want, what I could probably do is I could just put this whole wealth reconciliation statement here also, so that you could have a better idea that how the wealth reconciliation statement is prepared. So here we have the wealth reconciliation statement. Yeah, anyone has any issues or any questions with respect to it? Anyone has any questions, any issues with respect to it? anyone has any question, please do ask so that I can answer and then I can move forward. So is everyone okay with this wealth statement? Yeah, is everyone okay? Please, in case if you have any question, let me know so I can discuss that. Okay, so yes, this is how you prepare the wealth statement. And what happens is this is wealth statement, not a cash flow statement. So what you need to do is that you need to, for every single transaction that's happening, you need to understand that what is going on with respect to the wealth. Like it's not about the cash flow, it's not about, it's just about the wealth, which is what is happening to the assets, what is happening to the liability. That's what is important. Okay, so that marks the conclusion of the wealth statement. So I hope that every one of you is okay with this specific computation of the wealth statement. So what I am going to do now is the next situation that I'm going to talk about is basically I'm going to discuss about the other aspect, which is basically one of the questions on the sales tax. We actually attempted this question. We had this handout in the yesterday's session, and we attempted several questions from it. But there are few questions which are left, so I'm going to be attempting those specific questions. So the question that I will be attempting is basically a question named this Saima Associates. This is a question which is going to be available to you people in the handout section. You will have access to this question in the handout section. The name of the question is Saima Associates. This is a question on sales tax. Kindly come to this specific question so we can attempt it. The question is, it says sales tax liability for August 17. You can find this question in the handout section with the name of the file, which is basically the name of the file is practice question day 2. Practice question day 2, page number 7. Okay, so we are now going to discuss this specific question. The name of the question is Saima Associates. What I would want you people to do is that kindly go through this question, Saima Associates, and try to attempt it, and then we shall start discussing this question, Saima Associates. Okay, so let's just start discussing about this question. Since we have also discussed similar type of questions in the past pertaining to the sales tax, this question is going to be very detailed and a descriptive questions covering a lot of things. So let's actually start discussing about it. The first thing that is mentioned here is it says SIMA Associates is registered under the Sales Tax Act 1990. As manufacturer, come distributor, come retailer. Further, it says following information has been extracted from its records for the month of August 17. So the information has been extracted from its record for the month of August 2017. There is supplies made to registered person. There is a supply of taxable goods to unregistered person. The exports are 1.5 million and the exempt supplies are 1.7 million. We know that unless something else is mentioned, the taxable goods to registered person are going to be taxed at 17%. This is going to be taxed at 17% plus the 3% for the tax. The exports are going to be taxed at 0% and they are not going to be taxed at all because they're exempt supplies. So that's one of the things that is there. Now what next is there? We are being given purchases from the registered supplier for 20 million. The taxable goods from unregistered supplier, when you purchase from unregistered supplier, you don't pay sales tax. Exempt goods from registered suppliers, so that is going to be no sales tax applicable on it. And this is again going to be 17% applicable on it. Now what next is there? It says the following additional information is available for August 2017. The following additional information is available for August 2017. Now what is this additional information which is available? It says supply of taxable goods to registered person include the following. Goods invoiced at 325,000, net of a special discount of rupee 125,000, sold to government official. So what I'm actually going to do is I will perform the workings to this question in this Excel sheet that I'm maintaining because this is going to be shared with you people also at the end of the webinar session. SIMA Associates. So when we talk about this SIMA Associates, I'm going to talk about the SIMA Associates, which is a question on sales tax. SIMA Associates, it's a question on sales tax. Now, what's the first thing that's going to happen? It says following additional information is available for August 2017. Supply of taxable goods to registered persons include the following. Goods invoiced at 325,000, net of a special discount of 125,000, sold to a government official. So you could remember this, that if the discount is offered, then such discount is only deductible from value of taxable supplies if the discount is part of normal business practice, and also the amount of discount is mentioned on the purchase invoice. So if we cover up this specific section, the amount is the discount is of special nature. So since this discount is of a special nature, the tax will be imposed on rupees 500,000, which is basically 325 plus 125. It's not going to be 500,000, it's going to be 450,000. Why? Because it's going to be 325 plus 125. This is how the discount would prevail. The next situation is, it says on 1st August 17, uh, Sima Associates launch Halloween toothbrush, which is covered under third schedule. The retail price of the toothbrushes is rupee 100 each. However, being the first month of launching, it was sold at a discounted price of 75 each. 4,000 toothbrushes were sold in August 2017. So now we have got a situation which is actually a third schedule item. So when you have got a third schedule item, so what actually happens with those third schedule items, let's try to discuss and let's try to understand. Basically what happens is, when we talk about third schedule item, so the toothbrush, they are third schedule item. How do we know? Well, it's actually mentioned in the question, but also we remember it from the list. But even if you don't remember, the examiner will give you some guidance in the exam. So when we talk about toothbrush being a third schedule item, what is going to happen? We would actually say that the toothbrush was being sold at a discounted price of 75 rupee each. 4,000 toothbrush were sold. So the sales tax is imposed on third schedule item at ultimate retail price from the manufacturer. So sales tax is collected on third schedule item at the ultimate retail price from the manufacturer. So this is how sales tax is basically collected. So the price on which sales tax will be applicable in this case shall be 4,000 into 100. It shall be 4,000 into 100. This is what the applicable price is going to be. Now what next is here? Let's talk. So if I discuss a bit further, it says exports include taxable goods supplied of rupees 500,000 to a retailer in export processing zone. Now, what happens is, um, export processing zone is a zone which is basically defined by the tax authority as one of those zones where where usually the companies who are registered for the purposes of export. But if you supply goods in export processing zone to an exporter, then they would be subject to 0%. But if you supply the goods in the export processing zone to somebody who's not an exporter, but instead a retailer, then the sales tax will not be, then basically the sales tax will be applicable on it at 17%. So what happens is, supplies to a retailer in export processing zone is not subject to zero rating because goods are not used for exports and rather are being used for local supply. Therefore, a tax rate of this 500,000 will be taxed at 17%, and it needs to be removed from the exports. Remove from exports, that is what you need to do. Why? Because what happens is the goods which are supplied to retailers in EPZ are being supplied for retail sales. They're not being supplied for the exports. Had they been supplied for the exports, then the zero rating would have prevailed. Since they're not being supplied for exports, therefore the zero rating is not going to prevail on it. Okay, now what next is there? Let's move a bit forward and let's talk about it. Basically, the next thing is it says that exempt supplies includes distribution of free samples of exempt goods among the vendors. Value of such goods amounted to 80,000. Value of such goods amounted to 80,000. Now, basically what happens is since they are exempt supplies, so since they are exempt supply, therefore supply of free toothbrushes shall not have an impact upon the sales tax calculations because the goods are exempt. Even if you supply them free of cost, nothing is actually going to happen. The reason behind that is they are not liable to be charged sales tax upon it. Now, what next is there? The next situation is it says uh, the purchases from registered suppliers include material worth rupees 350,000, the payment of which was made by depositing cash directly in the business account of the supplier. So the purchases for which payment is made in cash, input tax on it shall be disallowed. Input tax on it shall be disallowed. Further it says, material worth rupees 800,000 against which a discrepancy has been identified by the crest. What is this crest? CREST actually means computerized risk evaluation of sales tax. The CREST actually means computerized risk evaluation of sales tax. So when we talk about the CREST, it's computerized risk evaluation of sales tax. So this is a system which is introduced by FBR. What happens with this specific system is that if there is actually a discrepancy between what the supplier has indicated as a sales value and what the customer has shown as the purchase price. So what actually happens is the CREST system of the FBR, it identifies the difference. So resultingly what happens is you need to understand that in case if the discrepancies has been indicated by CREST, so the input tax shall not be allowed on the discrepancy reported by CREST. So if there is a discrepancy on the crest, the input tax shall not be allowed. The input tax shall not be allowed. Okay, now what next is there? Let's talk. It says an amount of 2 million paid for purchase of raw material. However, only 30% of the goods are supplied during August for which sales tax invoice has been issued by the supplier. So if you could actually remember that when we talk about the time of supply, so the time of supply actually means that it's the earlier of date when the goods are received, or the date when the goods are made available, or the date when the payment is received. So what is actually going to happen in this case is uh, this is going to have no impact. There's going to be no effect on sales tax calculations of goods partly delivered by supplier, and the entity can claim input on the entire amount advanced to the supplier. So the entire amount that is advanced to the supplier, the input um, will be claimed. Now what next is there? It says on August 1st, 2017, CA executed an agreement with Majid Sons for sale of locally purchased goods worth 225,000. Agreement empowers MS to obtain delivery of these goods anytime it likes. So it says on 1st August, CA executed an agreement with Majid Sons for sale of goods. So basically what happens is the sale of goods, since uh, um, the contract entitles Majid Sons to take delivery of goods as and when they want, and the goods are made available for delivery to them. Hence, they meet the definition of definition of time of supply, and therefore sales to be recognized in current period. So although the goods have not been delivered, but there's a contract between you and Majid's son which entitles Majid's son to take the delivery of the goods as and when they want, and you have made the goods available to them also. Now what next is there? It says supplies returned by different registered persons amounted to 756,000. Proper debit note and credit notes were raised within a specified time. So basically what happens is um, all that you need to understand is that if the supplies are returned, so what happens is the output tax shall be reduced if proper debit slash credit notes are issued. So if the proper debit notes and the credit notes are available, then what happens is the output tax shall be reduced. So that is what you have to do. The output tax shall be reduced. Now what next is here? It says the auditors have proposed a provision against obsolete and expired stock of 285,000, which is lying on CA's warehouse since January 2016. So basically what happens is it says supplies returned by different registered persons amounted to 756,000. Proper debit credit notes is received. Now it says the auditors have proposed a provision against obsolete and expired stock of rupees 285,000, which is lying in the warehouse since January 16. So we are talking about August 17. The input tax cannot be claimed on this because it was in January 16 that the goods were purchased, but now they have been expired and obsolete. It says the machinery purchased during the month was commissioned into operation on 31st August 2017. Excess of input over output was 75,000 so and so, so and so. Now what exactly is going to happen? How would we go about it? Let's try to have a discussion. Let's try to have an understanding about all this. So basically, what is going to happen is when we talk about the machinery, there's something that you need to understand. The input tax of machine, it will not be applicable. The 90% adjustment rule, the 90% adjustment rule will not be applicable on it. 90% adjustment rule will not be applicable on it. That's number one thing. So the 90% rule will not be applicable to it. That's number one thing. The second thing is what happens is you need to apportion, because what happens is the exempt supplies, um, the sales tax input on the exempt supplies is disallowed, and the sales tax input on the exports is actually claimed as refund. So now what I'm actually going to do is I'll open the examiner's answer to the question so that you can have an understanding and idea about it. Let's have a discussion about the examiner's answer to this specific question. If you could see, it says purchases from registered suppliers, 20 million was there. There was this 350,000 adjustment. What was that 350,000 adjustment? That was an adjustment um, of this which was paid in cash. Then there is this 800,000 which was the material worth 800,000 which was purchased from a supplier whose name was mentioned in the crest. So this is what it was. Now what next is here? The next situation is purchases from unregistered supplier inadmissible, exempt good is inadmissible, uh, the crest discrepancy is inadmissible. Then there was this machine of 17%. So you now have the total input tax here. Then it says admissible or unadjusted input tax. We'll go on the calculation. It says input tax for the month, then at excess of input over output of July 17. So there is some unadjusted input tax which is being brought forward and mentioned here. Now, if I talk about the sales tax debits, which is called the output tax. So the output tax, you had this 15 million plus 500,000, one of the sales that wasn't shown, and then 325,000 and then 300,000 is what is being removed from here. And the total taxable supplies to government official is being added at 450,000 here. Majid Sons is there, unregistered persons is there, the further tax would come again. Exempt supplies, free samples, no impact. Exempt, zero rated, there's going to be an impact. Output tax for the month is this. Less sales returns are going to be deducted. Total output tax for the month. Now, what happens is, if we talk about this output tax, now let's try to understand. So basically, the amount mentioned here, this is 90% of output. This is actually 90% of output. And the admissible credit is basically the lower of. Input tax excluding the fixed assets and the output tax. So whichever is lower, this is claimed. The remaining amount is this. Then you've got input tax on fixed asset, which is admissible. Now, why have we got 18.75? Try to understand this. This is registered sales. This is unregistered sale. This is Majid San. This is government official. This is taxable. This is 18.75. The exempt supplies are excluded. The exports are excluded. So you've got 18.75 out of 21,450, the total sales. Input tax on fixed assets is this. And then you've got further tax on supplies to registered person. It's mentioned 2%, but it's actually the answer based on the old law. So it's 3% for your case. So it's 3% here. This is added. And then we've got sales tax payable. There is another thing which is sales tax to be carried forward. Now you see you've got an output of this. You've got input of this much amount, and this is the amount of input that has been adjusted. So the difference between these two will actually be carried forward. Less the 148,601, this is to be carried forward. Now what next is there? The next thing is the sales tax refundable. What is this sales tax refundable? The sales tax refundable is pertaining to the exports. The exports which have been made, the sales tax on fixed assets and the other sales is being computed on this, and it's claimed as refundable. Is everyone okay with this calculation? Is everyone okay with this calculation? Do you have any questions relating to it? Any questions, any problems relating to it? Is everyone okay? Okay. Can I have feedback of you people about how this session is progressing along for you people, and how effective it is, and do you want me to add up something or anything to these specific things, to the specific way the session is being conducted? Your feedbacks would be highly appreciated. Whatever you want to suggest, whatever you want to tell, whatever comments that you have, it's going to be highly appreciated. Okay, so is everyone okay with this? Do you have any comments, anything that you would want to ask, anything that you would want to know? Okay. Anyone has any questions? Okay. Yeah, thank you for your feedback. Thank you very much. Yeah, it's highly appreciated. Okay, so we'll keep it till here. Inshallah, we will continue tomorrow with our session, and we shall be discussing more things, inshallah, in tomorrow's session. So look forward to seeing you people tomorrow, inshallah, with our session again. Thank you very much for your time, and thank you very much for attending the session. Uh, let's meet up tomorrow, inshallah. Thank you.